Okay, guys, we are going to, this is an important video, okay? Not just because I have a big head or something, I want you to watch my videos, but this one is important. It's a lot better than the other videos that I posted for previous semesters and stuff. Hopefully it'll be a lot better. Okay, this is where we left off, right? With just analyzing transactions. Hopefully that made sense to you and it worked good, okay? But this next concept, students sometimes struggle with. Okay, so we're going to talk debits and credits. We're going to talk journal entries and carry basically this transaction analysis onto that next step. Okay, the next step in the process. Okay, so you can see this looks super complicated, but I'm going to simplify it. Okay, I mean, you can look through this also, but I'm going to simplify it. We'll move off of this slide quickly. So we're just going to talk debits and credits. And so let's just look at these ones right here. Okay, so the issue with debits and credits is sometimes students have already a perceived notion of like credit is a good thing, a debit is a bad thing, or vice versa, or something, or you think one increases, the other decreases. Don't think of it that way. Okay, go back to just like it's a new concept. And the concept that you need to know is that debits are on the left. See that? On the left side of this T account is what we call it. Okay, so a debit is on the left and a credit is on the right. Okay, and that is always the case. So if you look at this, debits are on the left, credits are on the right. Okay, now whether it's a positive thing or a negative thing, that depends on the specific account. Okay, so I'll show you that. So in a journal entry, a debit, okay, so a journal entry is a way to record a transaction, okay, and so we always have a debit, at least one debit and at least one credit. Okay, so just imagine we received cash, so you would debit cash, and you'll see how it's on the left here in just a second. Okay, so we write down cash, and then let's just say that we did work. Okay, so revenue would be the credit. Okay, so do you see how this here is on the left and then revenue is on the right? You see how it's indented over here to the right? Okay, so that's what I'm saying when I say debits are on the left and credits are on the right. Okay, and we can jump down here and like see right here, revenues. A credit increases a revenue. Okay, and so that's why that would make sense. So then the amount of money, whatever, $10 or something like that. Okay, so that's what I'm going to teach you more about in this this video. I'm not going to use all of this stuff here, all this, because it's complicated. Okay, so instead I'm going to simplify it, and it really, this covers everything. This covers every account, every broad category that we have in this class. Okay, but really any financial accounting class. Okay, so these three accounts here have normal debit balances. Okay, that means a debit is going to increase anytime you put this account on the left. It's going to increase that account. Okay, so the titles of these accounts are assets, which we just saw that a debit increased the asset account. Okay, expense. Okay, a debit is going to increase it. Okay, and then dividends is also going to be increased with a debit. Okay, so if you want to increase that account, you would debit that account. Okay, so that would be here, any of those accounts. Okay, and then here's the credit, right, of the journal entry, or in a T account, here's the debit. Okay, all right. Now these accounts here, you're going to credit these accounts to increase them. Okay, and this is why like students struggle with this concept, because they just say like, well, why can't we just increase the account? Why can't you just put a plus or a minus? Well, because we're putting them into journal form. Okay, so we're recording these entries into an actual journal. Okay, and so a journal is going to have a whole bunch of debits and a whole bunch of credits, and then at the bottom of it you can sum them and make sure they equal each other. Okay, and so now for our credits, you have liabilities, right? A little goofy, sorry. Liabilities, revenue, which we just saw, revenue, and then common stock. Okay. So to increase any of these three accounts, you credit those accounts. Okay. They also have what we call the normal balance. So at the end of a period, your assets are always going to have a debit balance unless you mess something up, or your revenue is always going to have a credit balance, or your common stock is always going to have a credit balance. Okay, that's what we mean by normal balance. Okay. What else was I going to show you with this? Oh, okay. So what's interesting is this is the accounting equation, and you'll notice expenses, and so the accounting equation, assets equals liabilities plus equity, right? Okay, so here's your assets. You can see that, assets. Here's your liabilities, right? I have a normal credit balance. And then equity, remember there were two ways to increase equity and two ways to decrease equity. So here are your two ways to increase equity, revenues and common stock. So you'll increase equity with credit entries, okay, which equity has a normal credit balance. And then you'll decrease equity with debits. And the two ways to decrease equity are expenses and dividends. Okay, so those are your credits. Okay, so you've got to understand this. You've got to get this memorized, and you've got to practice it so you really have it down. If you don't, you won't do well on this first test, but then every other test the whole time, like it uses these same concepts. Okay, and so it's really important. I actually ought to, well, I should have done the video on my laptop so I could talk to you a little better, but I'll get better at this also. Okay, so let's do some practice. Okay, so you can read through this one on your own. This is that chapter 2, like transactions or practice problems or something like that. But we identify transactions by using source documents. Then we figure out how that transaction impacts the accounting equation, and then we record journal entries. Okay, so a journal entry, just like actually someone mentioned journaling, or well, I can't remember. Anyway, never mind. A journal entry. It's just a chronological. It's the transactions of a business in chronological order. Okay, and each entry has to equal itself, or it impacts the accounting equation in equal amounts, right? So if assets go up, something on this side of the equation has to go up, or assets also need to go down. Okay. Don't worry about special journal entries. We're just doing everything in the general journal, the general ledger. Okay. And yeah, so that'll work there. And then we're going to go through some practice problems. Okay. Oh, my wife's calling. She's probably looking for me. Crap. Here, let me see if I can pause this. Can I pause the recording? Okay, I'm back. I got my Adster now too, huh, Ad? And I'm gonna have to stop again when breakfast is ready, but let's get going on this. Okay, so we're gonna analyze the transaction and do the journal entry, and this is a big part of the test, right? So We already analyzed the transaction for this type of problem, but I'll probably do it again just to make sure you got it down. Don't ever hesitate on these videos to speed them up or to skip around or leave a little note. If the video is terrible, let me know. I'll re-record it or something. So yeah, let's do it. So I'm going to turn off the video now on that. And then we'll get going on this. Okay, so 2 individuals each invested $30,000 in the corporation. Each investor was issued 3,000 shares of common stock. Okay, so what we're focused on is the economic impact to the business, right? So if we look at the equation, okay, the business is receiving cash, right? So, and it's from 2 individuals, so it's really $60,000. So our assets are increasing, right? And the other thing that is increasing is equity, right? Remember that common stock increases equity, okay? So that's how the accounting equation is impacted. And you'll need to do this on the test. And you can just do arrows. You don't need to put numbers or anything, but just show how the accounting equation is impacted. Now let's do the journal entry, okay? So if you have this down, A, E, D, and then LRC. Oh, and a way you can remember this is all elephants do love rowdy children. Okay, so AED, these are all debits, and these are all credits. Okay, in order to increase these accounts, you credit them. In order to increase these accounts, you debit them. Okay, so cash is an asset, right? It has future value to the business. It's a resource to the business. So we would debit that account, cash, for $60,000. And then in order to increase the equity account, right here, we got to increase this equity account. Remember, we can either credit common stock or we can credit revenue. Well, it's not revenue. We didn't do any work, right? We just issued stock. And so common stock. Okay. And on the test, you can just abbreviate that CS. Common stock is credited. See how it shifted over. So like here's your debits. And here are your credits. See how the common stock is indented. That's showing this is on the right and cash is on the left. Remember, debits are always on the left, credits are always on the right. So that's your first journal entry. Cash is increasing by 60,000, so we're debiting that account. Common stock is increasing by 60,000, so we're crediting that account. Okay, hopefully that made sense. And you can look at that. Obviously, you can look through these journal entries without my writing on them and see them too. Okay, and what I really want you to do is do these, go through and practice them without looking at the solutions, right? Okay, so let's see here. We borrowed $40,000 from a local bank and signed 2 notes. First note for $10,000 requires payment principal 10% interest, and then the second note for $30,000, blah blah blah. It talks about all that other stuff. Okay, so we're not worried about anything into the future, right? We're just focused on this very moment, and this very moment is we're receiving $40,000 of cash and $30,000 of cash, and they're both loans, right? They're both liabilities. So if you think about that, assets equals liabilities plus equity. Our assets are increasing, right, by 70,000, but it's an obligation. We have to pay this money back to the bank, and so that is a liability. That is a future obligation. So our assets are going up and our liabilities are going up. Okay, so then if we go A, E, D, L, R, C, to get our assets to go up, we debit them. So cash. And if you can't remember the name, the specific name of the account, you can always, instead, like, let's say you can't remember cash, that we received cash, you could instead write in there asset instead of cash. Okay. So anyways, debit cash, 70,000. So I'm kind of wrestling with my daughter just a little bit. And then because it's a liability, to get a liability to go up, you credit that account, right? So you could either just put liability or right here, it's saying it's a note. Okay, so note payable. Okay. Means we owe that money to the bank and it's $70,000. Zero, but it's there. All right, so debit cash, credit note payable. There's your journal entry for borrowing money from a bank. Huh, that's interesting. Why is it only $40,000 here? Second note, yeah. Anyways, you could do it in two separate journal entries. You could do it just in one journal entry too. Okay. All right, right here. So paid $24,000 in advance for 1 year of rent, okay, on a building. So assets equals liabilities plus equity. Okay, so some of you would think like, okay, we're spending money, right? We paid $24,000. So we're spending money. So that must be an expense, okay? It's not though, because we actually haven't consumed any resources. Expenses are when we consume resources. So really what we have going on here is our cash is going down by $24,000, right? We paid out cash. So to get cash to go down, we credit that account, $4,000. Okay, but it's a credit. Our debit is actually, we have a resource that's going to go up, right? Because now all of a sudden we have all this accumulated rent, like what we call prepaid rent, and that's a resource to the business, right? That's going to provide economic value to the business into the future. So we're going to debit that asset account. So we're crediting the asset account cash because it's going down, but we're going to debit prepaid. Okay. And so this is an asset here. Prepaid rent is an asset. Cash is an asset. To get cash to go down, we have to credit that account. To get prepaid rent to go up, we have to debit that account. You'll notice I wrote the credit first, okay? But I left space. You always put the debit in the journal entry first, okay? You can write the credit first, but you need to leave space in order to put the debit. So debits will always come first, right, and be up above the credit. Okay. Hope you understand that. Remember, elephants do love children. So assets to get it to. So just oh, a second. Good thing I don't have the video on because that was a yucky sneeze. Okay, so assets to get them to go up. Debit those accounts. To get them to go down, we credit the asset account to get it to go down. Okay. Next one. Okay, we purchase some office equipment from Etronics. Sorry, I'm making sure my wife isn't calling saying order is ready. Okay, so we purchased office equipment from Etronics for $12,000 cash. Okay, this is actually going to be similar to that last one. Assets equals liabilities plus equity. And so on every problem on the test, this is how you'll do it, okay? You'll do the accounting equation, and you'll show how it impacts it. So our cash is going down, right? Spent cash, but we're receiving equipment, okay? That's a resource for the business. And so our assets are also going up, okay? So I'll show that your cash is going down 12,000 and show that your equipment is going up 12,000. Sweet. So, I mean, if you couldn't remember cash as a specific account and equipment as a specific account, then you could debit, you could just put asset here, asset here. Debit asset, but you should be able to remember that. And the problems tell you what the account is. Okay. Okay. Purchase inventory. Okay, so we're purchasing inventory. Again, this is, let's just be, okay, but now something changed here. It's saying we purchase inventory, but we purchased it on account. Okay, so it's going to be just a titch different. We're receiving inventory. That's definitely an asset, right? It's a resource for the company that it'll use into the future. So our assets are going up for sure. But in this particular example, we're not using cash to buy the inventory. Instead, we bought the inventory on account. Okay, so because we bought it on account, we owe them money, which is an obligation. So our liabilities are going up. Okay, so if you go, okay, all elephants do love rowdy children. Okay, so our assets are going up, debit inventory. And then $60,000. And then credit, okay, you always need a debit, at least one debit and at least one credit. When you look at it, liabilities here, these all have credit balances, right? And so a liability, and so what we would say is accounts payable. It's going to be the credit, or don't remember that account, just put liability, $60,000. Okay, and that's your journal entry. So our assets are going up by $60,000. Our accounts payable are also going up, right, by $60,000. Do you see how we didn't record an expense? You might think like, oh, we bought inventory. That's an expense. No, because we didn't consume the inventory. Okay, we didn't use it up. We didn't sell it. We just increased an asset, a resource for the company, which is inventory. But we did it on account, so we owe that money. Therefore, we also increased a liability. Do you see how the equation still balances? Because you'd have 60,000 on this side and 60,000 on this side. Okay. Cool. Okay. So purchase supplies on account. Okay. Let me finish this one in a minute. Okay. Back. Let's keep going here. So purchase $2,000 worth of supplies. Okay, again, don't think of it as, oh, we're spending money, therefore it's an expense. Okay, don't think of it that way. Instead, think of it as, okay, what is the economic impact of this transaction to the business? Okay, so yeah, definitely we're using cash, so our assets are going down, right? But supplies, that is going to have economic value to the business moving forward, right? And so that's the definition of an asset. So our assets are going down, but our assets are also going up. To get our assets to go down, we credit that account, cash. To get our assets to go up, we debit that account, supplies. Okay. Cool. That's that. Okay, now we're gonna do, oh, I wonder why this is behind. There we go. Okay, so let me show you this one. So this one's a little tricky because there's going to be two journal entries here. Okay, and honestly, you won't have questions like this on this test. It's a future chapter, but I guess I have it here. So we'll go over it. Okay, so we have sales. So we sold merchandise. The merchandise cost us $20,000. We sold it for $35,000. Okay, so let's just think through this one first. What we sold it for. So assets equals liabilities plus equity. Okay, so think about it. We sold it for cash, so our assets are going up. Okay. And is there another asset specifically with this cell? No, don't think of it that way. Is there a liability? Do we have some type of obligation? No, right? We sold stuff that they would owe us money if they owed us, but they don't. They paid us cash. Okay. But we go over to equity, and remember, you have revenue and common stock that increase it. And then you have expenses and dividends that decrease equity. Okay. So revenue, that is the account we're interested in, right? And you look at this, AEDLRC, revenue has a normal credit balance. Okay, so this is gonna work. We're gonna have cash that we receive, $35,000. And then what describes why we increased our cash is this concept of revenue. Like we earned it, right? We did work, we provided merchandise to the customer. And so that's going to be revenue. Okay, so you could just credit revenue, or you could say sales revenue, right? Which has a normal credit balance. We credit that account to increase it. So $35,000. Okay, that's one journal entry. Increasing our cash, increasing our equity, and we increase equity by increasing the revenue account. Okay, so that's one part of it. The issue with this journal entry, what makes it challenging, and the reason that it'd be in a later chapter, is we also have to take into account that we no longer have that merchandise, right? Like $20,000 of our merchandise that we had for sale is no longer for sale because it's gone. Okay, so let's look at that part of it. So we'll do it down here. Assets equals liabilities plus equity. Okay, so think about it. When we purchased inventory, that increased our assets, right? So now we're selling it. So our assets are going down, right, by $20,000. And so we can just go ahead and credit that inventory. So it's going down $20,000. Okay. And then the account that explains why our assets are going down would be the expense account, right? Here, we're consuming resources of the business. Our resources are going down. And so we're going to record an expense. And in order to increase expenses, we debit those accounts. See, kind of interesting, right? Because with an asset, we increase that account with a debit. But an expense, we also increase that account. So for now, I'm just going to put expense. Or we could explain that account a little bit better, but for now, we're just going to do expense, $20,000. So just think of it as like, okay, our inventory is going down. The expense account explains why our inventory is going down. Okay. Our asset account cash is going up by $35,000. The revenue account is explaining why that asset is going up. And so if we go back to here, sorry, our assets are going down. And remember, expenses are one way that the equity goes down, one of the two ways. And so our equity is going down. You can see this still balances, right? So 20,000 down, 20,000 down on this side of the equation. Okay. Now the interesting thing is you also have $35,000 going up and $35,000 going up, okay, for the revenue. So that's why you have two journal entries. Okay. You can see it there. You should go through it on your own. Okay. Okay, so this one here, kind of similar to that last one, but now instead of selling it for cash, we're selling it on account. Okay, that just means they haven't paid us yet for the clothing. We've given them the clothing, they just haven't paid us yet. Okay, assets equals liabilities plus equity. Again, this one won't be on this test either, but it's good to just analyze any transactions you can get, right? So We know that our revenue is going up, right? Which means our equity is going up. And then our assets are going up. It's just not cash this time because it's on account. Okay. And so instead, they owe us money, right? So what we call that is a receivable. So our asset is account receivable. Okay. And that will be 3,500. So that's what we're debiting. And then we're crediting sales 2,500. Okay. So that's our journal entry. Debit the asset account to get it to go up, credit the revenue account to get it to go up. Okay. And then we deal with the inventory part of it. So our assets are going down and our equity is going down. And so to get our assets to go down, we credit that account. So inventory. Debit the expense account. 2,000. You'll notice sometimes I'll write the credit first, but I always leave space for the debit. Or sometimes I write the debit first and then do the credit. What I'm trying to do is get my mind going on this problem or on any problem, get it going, and so that I can remember what is debited or what is credited. I want to start with what is easiest first. And I'll typically write that down, and then that'll help me know what I need to do for the rest of the journal entry. Okay. Oh, let me just show you this real quick. Yeah, so technically this account, this expense account, is called cost of goods sold. Okay, but that is an expense account. Okay, so for now I'm just leaving it kind of the more generic term expense, but it is technically cost of goods sold. Okay, here. So we subleased, which means we have this building, we're not using all of it, and so we're going to lease out a portion of it to someone else. Okay, and so we subleased a portion of the building. The challenging part really is the language in accounting, like understanding what the problem is saying and then trying to communicate that, what the problem is saying in journal format. That's the challenging part. And so you'll learn to do it just by practicing a ton. Okay. So we received $1,000 in advance for the first 2 months of rent. Okay. All right. So on this one, we do our accounting equation. Okay. So we're receiving $1,000, right? So that's an asset. So you could debit cash $1,000. Okay. So our asset's going up. However, the next part is tricky, right? Because like, you know, if we had provided the rent, like provided the space for them and they had used it, then we would get to record rent revenue, which is equity, right? But here it's in advance, okay? So we actually haven't provided a service to them yet. And so what we really need to do is we're receiving cash, but we have a liability for the future, and that's going to increase our liability. Sorry, they're coming in just as I was going through that. Let me make sure I explain that better. So our assets are going up, we're receiving cash, but we have an obligation to provide them with a portion of our building. Okay, so we have an obligation to provide them with space into the future. Okay, so it's a liability. So you could just credit liability. Another account, that's the general, so you'd be right with that. This slide is probably going to show deferred revenue, which just means it's revenue that we haven't earned yet. Or a lot of textbooks will call it unearned revenue. Okay, all of those accounts though are just liability accounts. Okay, because we have an obligation to provide them with space for the next 2 months. Okay, now as those months pass, Then we'll reduce this liability. So to reduce it, we would debit it, and then we would credit rent revenue. But for now, remember, don't get ahead of yourself on these problems. Just focus on what is happening right in this very moment. So in this very moment, we're receiving cash and we have an obligation to provide them with building space into the future. Okay, so yeah, here they call it deferred rent revenue, but just know that's a liability account. Okay. Okay. This video may be getting long for you, but I don't know how many more there are, honestly. So we paid Birdwell Wholesale Clothing $25,000 on account, record payment on account in a journal. Okay, so all this is saying is we purchased, I think that what this is saying is we purchased clothing earlier, but we purchased it on account, right? And so we recorded inventory, but we recorded a liability. Now we're going to pay for that. We're going to pay off that account or pay money, the $25,000 towards the account. So our cash is going to go down. So let's credit that account cash, $25,000. And then since we're paying off that payable, or at least $25,000 worth of it, we're going to reduce our liabilities. Okay, so don't think of it as an expense. Just think of it as we're reducing down what we owed them. Okay, and so you could just put liability here, or you could put we're reducing down accounts. That's a liability account from AEDLRC. So a liability to increase that account, you would credit it. Therefore, to decrease it, you would debit it. So that's why we're debiting it. Let's see if we, yeah. Let's see here. So we're reducing our liability. Sorry, I just didn't know. The reason I wanted to look is I wasn't sure. Because I don't think there was a journal entry showing us buying this inventory on account. Maybe there was. But anyways, we're paying it off. Okay, so when we paid Birdwell Wholesale Clothing $25,000, we're reducing our cash, reducing our liabilities. See how this still balances. Okay, salaries. So paid salaries to employees for the first half of the month. Okay, so think about this. Our cash is going down. We're paying out cash. Okay, so we're crediting that account, 5,000. Okay. And then it's not a liability. It doesn't say that we owed them. And so now we're paying them. Instead, like think of it as the business consuming the work or using up the work of the employees. Okay. So our equity is going down. One of the two ways to get equity to go down is expense. And remember, AED, expense. To increase the expense account, we debit that account. So it'd be salaries. That's that one. Okay, so now someone is paying us. So remember, before we sold on account, which means we gave them the inventory, but they hadn't paid us yet. Now they're paying us. Okay, so really think through these carefully. Okay, our assets are going up. We're receiving cash, $1,500. Okay, but before, when we sold on account, we had our accounts receivable go up. Okay, now they don't owe us money, so our accounts receivable are going to go down. So accounts receivable is going to go down 1,500. Okay, so to get an asset account to go down, we credit that account. I think I might have spelled receivable wrong earlier. My bad. Pretty sure I did. Corporation paid its shareholders a cash dividend of $1,000. Okay, so assets equals liabilities plus equity. Okay, we're paying cash, so our assets are going down. So credit asset account, $1,000. And then our equity is going to go down. Okay, 2 ways to get equity to go down is expense or dividend. Remember, both of those have, to get them to go down, you debit those accounts. Get them to go up, you credit them. So AEDLRC. See that? So to increase those accounts, you debit them. To decrease them, you credit them. And so we would just debit dividend. Seeing if you, I would write this down at the top of your page, AEDLRC, debit, credit. But then also, like, because I credited cash first, because I knew we were paying that, and I knew that the debit had to be to dividends, right? So we debit dividends. Here they skipped right to retained earnings. Which dividends, when we close that account out, we close it out to retained earnings. Okay. Don't worry about that though. Just do it. I would do it this way. Or you can do it how it does it on the slide. It's fine. I'll be able to tell. Okay, sweet. So that's your journal entries. I think there are some other journal entries in another PowerPoint for chapter 2. There are journal entries in the practice problems for the exam. Make sure you do a lot of journal entries. Okay. Thank you for watching.